Hello. Welcome to NDBS Rupee Roundtable. Today we are going to discuss the outlook for Sri Lankan equities and thinking through stock picking. My guest today needs no introduction. I'm very pleased to have Asanka Herath from LYNEAR Wealth Management joining us today. Asanka has more than 15 years of experience in investment research and portfolio management. He worked in outsourced sell-side research for Deutsche Bank before joining LYNEAR, mainly covering European media sector. He was also involved in managing, training, and mentoring offshore analysts covering multiple industry sectors. And after that, he joined LYNEAR and he was involved in setting up the investment research team. And he helped build the business at LYNEAR when it started operations almost a decade ago. Asanka has an MSc in financial economics from the University of Essex, and he also has double degrees, BSc in economics from the University of London and a Bachelor of Law from the University of Colombo. Asanka, welcome to NDBS Rupee Roundtable.
Thank you, Vajrapani, for having me here.
It's always a pleasure. So let's begin with the first segment of the discussion. So in the first segment, we are going to have a deep dive into the topic at hand. So this includes Asanka's outlook for Sri Lankan equities. What are the sectors he's positive about right now? His investment philosophies, strategies, and we're going to have a bit of introspection into the lessons he has learned along the journey, both as an investor and as an analyst. And in the second segment, we are going to discuss Asanka's favorite book recommendations and the person he looks up to in the industry. So let's begin. Asanka, now in the topic discussion, I have a whole bunch of questions ready for you. Let's begin with your outlook for the Sri Lankan equity market. Before we get there, as an icebreaker, let me ask this now. Uh, Sri Lanka is finally seeing some hard reforms, which the country has been yearning for years for this. So the IMF EFF is here, and the authorities have published the DSA, and the debt exchange operations are almost on the verge of beginning. So, given this backdrop, do you think that Sri Lankan economy is currently going through a structural shift? And if that is the case, how do you think this will affect the equity market?
Vajrapani, I think all of us probably need to appreciate what is a structural shift or what is it that Sri Lanka is currently going through can be interpreted in multiple ways. Personally, I think what Sri Lanka is going through is green shoots of a structural transformation, with green shoots being the key phrase. The reason being, the measures that we are implementing now will take time for take full effect and will take time for us to successfully complete. Also, it is very possible we may need to take further steps to ensure that the measures we are not taking is not reversed in an election cycle or after a couple of election cycles. So because of that, I am more inclined to call them green shoots. Structural reforms are those which aims to improve efficiency, productivity, and stability of an economy in a sustainable manner. Sometimes it can involve addressing structural weaknesses in an economy, or sometimes it can involve a long-term plan to push a well-functioning economy to a higher growth plane. So if you look at in the Sri Lankan context, what is happening is that now we are addressing long-standing structural weaknesses. Some of them has been very well articulated by others, like low revenue to GDP, SOE losses, current account deficit, etc. While we are currently taking these measures in order to ensure that there will not be a change of course in a couple of years' time or in 5 years' time, we may also need to look at improving the institutional and governance framework so that these measures are held on to. As an example, we may probably have to go back to independent public service. Public service where public servants outside of policy decisions can remain independent of the government. We'll also probably need to look at electoral reforms so that people will vote and people get the option to vote for individuals who are capable of making sound economic decisions. Thirdly, we may even have to look at a way to incentivize politicians to take decisions which are beneficial to the economy in the long term, though it might be damaging in short-term election cycles. As an example, I mean, some of these we can see in other countries. We can look at a second chamber, where the members of the second chamber is incentivized to take decision by looking at the overall country, not a particular electorate. We can look at articulating and reinforcing some of these measures as constitutional amendments. So, because of the reasons I've articulated, I feel we are going through a structural transformation, but I'm more inclined to call it green shoots of a structural transformation.
Okay, okay. Makes sense. So while we are seeing these green shoots of a structural transformation, in this slide, I would like to know what's your prognosis for LK equities. Now, Sri Lankan equities now they are trading at almost 4.8 times PE on trailing 12-month earnings, a 60% discount to the long-term median PE. And if you even look at from the macro high frequency numbers, we already seeing some turnaround. Inflation is stemming from its gravity defying level we saw last year. And interest rates also, I believe, once we get more clarity and visibility on the domestic debt exchange, that will also return to same level. So given this backdrop, where do you stand? Do you think it is a good time to go long on LK equities?
For multiple reasons, I actually think this is a good time to go long on equities. I mean, first thing is an expectation of a structural transformation can drive equity markets. Then also you can have scenarios where specific reforms can lead to certain selected counters being highly attractive. Also, we need to realize that we are moving up from a cyclical trough, which can be beneficial to companies and corporate earning. So if I just dwell on the expectation of structural transformation, over the last 5 years, Sri Lankan equities has been shunned by foreign institutional investors. I mean, they have been wary of Sri Lanka's structural problems well before local investors became wary. Burgeoning external debt, I mean, this persistent twin deficit have been things that the foreign institutional investors have discussed in relation to Sri Lanka for a long time. I mean, as an example, starting from 2018 March, right up to January 2022, we had 43 months of net foreign outflow. We only had 5 months of net foreign inflow. So by the time the economic crisis actually exploded on our face, the Sri Lankan equities have become by and largely underowned by foreigners to an extent that has never been there, I would say, for the last at least 20 years. I mean, between December 2019 to September 2021, the foreign holdings in banks, companies like Hemas, declined by almost 50%. So what I see is that if global conditions permit, these foreign investors will slowly start coming back to Sri Lankan equities. Some of them will start coming back slower than the others, but we are already seeing signs of it. Amidst all the volatility we saw in 2022, the foreign inflows to Sri Lanka have materially picked up. During the 16 months from January 2022 right up to now, we have had 10 months of net foreign inflow. That is the case even if you take out strategic foreign inflows. If you very carefully analyze the shareholder list of companies and their movements, you can see increasing positions by fund managers like Hoskins Global, Aberdeen, Tundra, Arcadian, Parametric, who were virtually absent since the beginning of the COVID pandemic. So my sense is as time passes, there will be fund flows which will lead to re-rating of selected equities which are materially undervalued. Second thing is that very similar to what we saw with regard to Lanka IOC, certain specific counters can materially benefit and generate very attractive return for investors due to very specific reforms. So as a fund manager or as an individual investor, these are things that we have to keep an eye on. Thirdly, we have to realize that we are moving away from a period of high inflation, high interest rates, and contraction of real disposable income. We are going to witness decline in interest rates. It's not a question of if, it's a question of by how much and when. And the most of the funds which went into bank deposits, I would say middle of last year, will slowly start coming back into the markets around middle of this year. And we also need to take into account the good crop in agricultural sector, resurgence of tourism, possible reduction in electricity tariff in the second half due to greater dependency on hydropower, possible adjustment to individual income tax rates after the first review of the IMF program, and reduction of monthly debt service burden due to reduction on interest rates can drive pickup in disposable income. So there's a potential for consumer demand to gradually pick up from the trough we have experienced. Now, all of this will help improve corporate earnings from where they are. So I think we are at a point in time that one should very selectively deploy funds into equities and be bullish on equities.
So, Asanka, my next question is an extension to the previous one. So, in this backdrop, given the reasons you mentioned, are there any particular sector or any asset class that you're very excited and interested right now? I know this may sound a little bit repetitive because you gave some background in your previous answer, but I would like to have more of a surgical look into any particular sector and any asset class that you're excited about right now.
Sure. I think primarily I'm excited about consumer stocks, banks, and export counters. I think investors should keep a close eye on them. There are certain consumer stocks who have defensive demand, or the brand is strong, or where the industry's oligopolistic nature that they will not have to pass on the cost savings to the customers when the costs come off. In the last 6 to 9 months, we have witnessed consumer companies who serve the defensive consumer segment materially increasing their prices to pass on the cost. And these companies have witnessed substantial revenue and profit growth despite the volumes coming off. Now, with the demand likely to return, there's no incentive for these companies to materially pass on cost savings to the customers, though the costs themselves are coming off for various reasons like lower interest rates, currency appreciation, etc. So these companies are likely to see substantial growth in earnings in the next 6 to 12 months. This will be more the case for the larger players in the respective industries. The larger players have had strong balance sheets, strong logistics to grab market share from smaller players during the crisis. Secondary, even if the demand is not defensive but is actually discretionary, if the brand is strong or if the players in the industry usually generally work together to manage the pricing, they are unlikely to once again pass on the cost savings to the customers. So, with the demand returning, that means the volume returning, and the cost coming off, these companies with discretionary consumer demand is also like to report earnings growth as long as the brand is strong and there's no price competition in the industry. I mean, simple example is just take your shopping list and notice the fact that the prices of the basic commodities have come off, but the prices of most of the manufactured commodities haven't really come off. So that tells you these companies who are involved in manufacturing and serving the customers are actually keeping a higher margin. Second thing, our second sector are the banks. I think each investor will have to make his own assessment as to the quality of the balance sheets after taking into account of various scenarios related to the domestic debt restructure and non-performing loans. But one key thing is that banks are valued at book. Book consists of net asset, and assets are valued in nominal terms. A corporate who's in the trading business will today need a larger working capital because the prices of goods that they trade is higher. So that means the value of the loan that they will ask from their banker will be much higher. So inflation will boost the value of the loan book as well as the underlying collaterals through the crisis. So if the banks are to come off the crisis, what you will see is a very strong growth on the net asset value of the books on the nominal terms. So therefore, that in the mid to mid long term horizon, if the banks remain unscathed, they may look very attractive. Thirdly, are the export counters. What we are seeing on the export side in terms of slowdown on demand is a natural economic cycle. And some of the listed export counters have very strong track record in serving their end customers. And when the economic cycle turns, those counters are likely to see material earnings growth. And it's a question of what the respective investor's investment horizon is and how early he wants to start building the position. I do need to tell you, Vajrapani, that you are aware that we have active positions in the market. So my opinion can be subjective, and I would like the audience to be wary of that.
Sure, sure. No, I largely agree with what you said now, especially in the consumer sector. I was in the weekend, I was reading this Bloomberg Business Week, whereas the US companies, the first quarter 23 numbers, if you look at the earnings numbers, consumer staples, consumer defensive, they have beaten analysts' expectation as much as about 80%. Again, pricing power. Despite the commodity prices coming off, you don't see that necessarily being passing down to prices. So they're retaining the margins. And again, from the back.
Vajrapani. I mean, as an example, if my memory serves right, apparently the Hershey's chocolate bar went through a material reduction in size during 1970s when US went through a period of relatively high inflation, but their prices didn't come off. Now, if you
Okay.
go to the supermarket and our supermarkets and look at some products, you are witnessing the same. The prices may have slightly come off, or the prices might be remaining same from the peaks of September, but the sizes are smaller.
Correct. Okay. Especially soaps, if you look at the size have come off. And even now the palm oil prices have come down. We don't see the prices being, returning to the level they were. Fair point. And again, I think banks also, now that given that we have soft GDP, public debt to GDP target in the DSA, what some analysts now forecast is you're looking at about a base case scenario about maybe 15 to 30% principal reduction for Eurobonds. So if that is the case, banks have already booked about 45%. So we might even see some kind of provision reversals also happening from that front. So interesting perspective there. So consumer banks and exports. So with that, I'm going to move to FIIs, foreign institutional investors. So I do know that you deal a lot with foreign institutional investors. So what do you hear from them? Are they excited about the opportunities in the market? Do they find the valuations are very attractive right now? Especially from the currency front, do they think that the currency risk is largely behind us?
I don't want to claim that I deal a lot with foreign investors, but for the purposes of investment management, I try to understand what they think. So let me share what I think actually. I think foreign investors have witnessed these crises like what we have gone through more than local investors. There are foreign portfolio managers who, during their professional lives, have witnessed the East Asian crisis, who have lost money and who have made money during the East Asian crisis. There are foreign fund management institutions who have institutional memory of navigating through crises like this. Therefore, in my opinion, the foreign institutional investors are more prepared to objectively look at Sri Lanka's equities even more than the local investors. So the question is, what is the take on currency and what is the take on valuations and corporate earnings? In my view, the risk of the currency depreciating is by and largely behind us. I know there's a school of thought that currency might depreciate materially when we relaxes import restrictions. But I think we have to take into account that after the debt restructuring, that our foreign debt service will be materially lower, and that will, during the period of the extension on external debt obligations, can lead to annual dollar currency savings. So I feel that if Sri Lanka prudently relaxes import restriction, the potential for currency to depreciate further is very small. And as I mentioned earlier, that there's quite a few sectors which are undervalued, and specifically in the large to mid cap counters. And these are the counters historically FIIs have invested in. So in my view, it's likely the FIIs might feel the currency depreciation is behind us, and there are companies that they're comfortable with which are at multi-decade low valuations. It does look like the foreigners share that kind of view because, as I mentioned, during 2022 and especially during last couple of months, foreign interest, foreign inflows to the market have materially picked up.
Asanka, I do agree with what you said. If an investor has the patience, the courage to stomach the current volatilities that the market is going through, perhaps once we come out of it, the returns could be actually, outsized returns you can experience. I was recently listening to a podcast, Michael Fritzel from Asia Century Stocks, where the Fusion Capital portfolio manager, Michael Magai, he joined, and he said that he's been looking at emerging and frontier market equities for the last 2 decades, 2 to 3 decades. And he was saying once Indonesia came out of the Asian financial crisis, out of the 400 listed stocks, about 35% emerged as 100 baggers. And that's almost like 8%. So again, reiterating the fact that if you carefully think and take good positions, perhaps this is like a once in a lifetime opportunity for an investor.
I mean, just to interrupt you there, I personally think that if things pan out the way um, we want it to pan out in terms of economic recovery, the equity returns could potentially mirror what we saw in the immediate aftermath of the war, conclusion of the war.
Sure, sure. So now let me ask a question now. So soon after we got the IMF deal, we kind of saw like a knee-jerk reaction. The equity investors almost celebrating gleefully, and then once this domestic debt restructuring announcement came, we kind of seen the sentiments have waned. So at this point, what is, in your view, what is the inflection point are we looking at? Is it a successful conclusion of the domestic debt exchange? Uh, what do you think?
Interesting question, Vajrapani. But before I get into that, can I just mention that, in my opinion, our market has got into a particular bad habit of excessive trading. Now, that excessive trading has become a self fulfilling prophecy. I mean, most of the local investors got into the habit of buying on the rumor and selling on the news, even though at the point of them selling those shares are materially undervalued both in the medium to long term. Now, that strategy has been generating returns because, by and large, sophisticated investors have been absent from the market. Historically, sophisticated investors have been the foreign funds. Now, you have already witnessed since middle of March, there are certain counters which are materially moved up. So, those individuals who exited prematurely through excessive trading have got penalized by for not holding the share despite those shares being undervalued. Going back to your question as to what are we waiting for a material re-rating, I think I see two categories. First thing is, I think the foreign fund flows will materially improve when there is further clarity on the debt restructure. And specifically, once the restructure is successfully done, this crisis can be most investors will consider the crisis as being behind us, and at that point, there can be a further re-rating with foreign funds picking up further.
Okay.
Second aspect is the role the local investors may play, the local fund flows may play in re-rating the market. It's around August, September last year where the 1 year FT rates, etc., materially moved towards 30%. And I do believe large amount of funds went into those. By now, the rates have come off. Any maturities at the point of reinvestment will not get the same kind of yield. So therefore, I believe from starting from about the 6 to 8 months of this calendar year, you might see local funds slowly coming back into the LK equity market. And I think that also can lead to a more sustainable re-rating of the equity markets.
Okay. Okay.
caveat though is you will still get foreign funds who are very comfortable with Sri Lanka, who've seen their crisis, who may not necessarily wait for the debt restructuring to be finalized. And I think both of us know, and most of the audience would know, in the last couple of months, we have witnessed that happening.
Correct. Correct. Also, do you think, now if you look at the frontier market, our PS valuation, now Pakistan has its own problems they are going through. I think Pakistan is perhaps where Sri Lanka was a year ago. Both Pakistan and Sri Lanka trading at what below 5 times on trading numbers, and then you have Vietnam trading I think about 12 times and Bangladesh at 20 times. So perhaps I think from in the eyes of FIIs, Sri Lanka is definitely like a frontier market darling. Would you say that?
Sadly, no. The
Okay.
reason being, in mid 1990s, we were the frontier market, darling, right? But we took so much time to go through with our structural reforms. I mean, we failed in pushing both our capital markets as well as the economy to a higher growth plane. And so most of the other markets actually became a lot more attractive. For us to be considered a frontier market darling, I think majority of the structural reforms that we are discussing now need to happen. So if they happen, I do see Sri Lanka becoming a frontier market darling. But we don't necessarily have to be a frontier market darling to see material foreign inflows to Sri Lanka, given how underowned our foreign holdings are. So our foreign inflows will come from that set of foreign investors who have been in Sri Lanka over the last 10 years or so, who decide to remain on the sidelines over the last couple of years. I do believe that fund flows from them alone is sufficient for our small market to materially re-rate.
Okay. Okay. So before I jump into our next set of questions, just one last question, the same theme. Now, do you believe that now some of the stocks, large cap stocks, particularly that of John Case, that of Dialogue, and even some of the banking stocks, do you believe that for a meaningful re-rating to happen, uh, the absence of foreign fund flows has also been a contributory reason, given that the amount of excess liquidity that is out there when it comes to these names. So you need some uh, heavyweight lifting to happen with the foreign fund flows coming in and absorbing this excess liquidity.
I'll take that question in two parts. First thing is that has the absence of foreign funds contributed to these large caps remaining undervalued? Yes. I think our local investors have focused on small caps where their own fund flows are sufficient for re-rating, and the large caps, despite their strong earnings profile and undervaluation, by and large has remained untouched. So that is true. However, if you are on your question as to do you need foreign fund flows to absorb the excess liquidity out there, I would say no, simply due to the fact that I don't think that in most of the instances there's much excess liquidity at all. And if you just look at the three banks and look at what percentage of those banks are held by foreigners and compare with what it was in December 2019, that itself tells you that our companies are underowned by foreigners. So there's no excess liquidity. There have been very specific instances where I think the local markets have got spooked because certain particular funds may have been selling certain large caps. But if you just look at the last 3 months, you would have witnessed that they have got very easily absorbed by local funds in combination with foreign funds which are coming in. I actually think very similar to how some of the local investors who built material stakes in large caps prior to the end of the war benefited from lack of liquidity when foreign funds came back at after the end of the war. The individuals who build positions now onto our large caps will materially benefit when foreign fund flows pick up because there's no liquidity, is my personal opinion.
Okay, okay. So with that, now we have covered your outlook for Sri Lankan equities, and you mentioned some of the sectors, some of the names you are currently excited about, and then we discuss FII's angle also. So next, I'm going to move into investment philosophy and strategies. Have a few questions there. So, firstly, let's begin. Asanka, I know you've been in the market for a long time. So, can you walk us through your investment philosophy, your approach, and perhaps how this evolved over time?
So we tend to adopt a value with catalyst approach. Shares have to be both undervalued and have a catalyst that can drive a valuation re-rating. This is distinct from value investing founded by Benjamin Graham, where you buy a share at a discount to intrinsic value. The problem with value investing is you do not know when the market will recognize the undervaluation and re-rate the share. So you actually run the risk of holding an undervalued share for a prolonged time, which is suboptimal for your returns. So what we try to do is that we try to pick shares which are undervalued and which may have catalytic events in the horizon, such as a positive earnings surprise, large dividend, an M&A, or potentially a large foreign investor looking to build a stake and try to build a position on such shares. And on the question of whether it has evolved, I think we have increasingly moved from value investing to value with catalyst investing.
Right, right. So, can I ask now? Many people believe that it's best to invest in what you know. Do you agree with this idea? And how do you possibly balance this approach when it comes to diversification?
I think Vajrapani, people should only invest with what they know. And diversification is not an excuse to break that rule. So what do you try to see in diversification? In diversification, you are trying to reduce your portfolio risk. So instead of buying one share, you will buy, let's say, two shares. But if that strategy is going to reduce your risk, the two shares you are buying should have different risk return profiles such that the risk return profiles are not dependent from any common factors. Or else, though you might buy two shares thinking you are diversifying, they may have common factors, so their risk return profiles might be similar than the investor thinks. So you do not achieve the diversification that you want. So whether you are looking to diversify or whether you are looking to concentrate, an investor should only invest in what they know.
Okay, okay, makes sense. So now let's look at again um, another philosophy or in another school of thought that is out there. I would like to know what are your views about this buy and forget investment strategies. Do you think that such a passive investment strategy still holds true in this time and age where the economic cycles, the business cycles, the market conditions are changing ever so rapidly.
I think one has to be cautious with the buy and forget investment strategy. Increasingly, the global economic and political cycles have become shorter. We all know that such cycles have adverse impact on share prices, corporate earnings, etc. And in frontier markets like Sri Lanka, the cycles are even more shorter. So therefore, a buy and forget investment strategy have the potential to generate suboptimal returns compared with a more active management strategy where majority of the time your active decisions are accurate.
Right. And now let's come to small cap investing. Now again, small cap investing is unloved by professional fund managers due to very many reasons, including high volatility, low liquidity, and in terms of earnings visibility, it's rather less. Therefore, all these requiring surgical active management. Where do you stand? Now, I'm asking this question particularly because I've seen you making a bold investments when it comes to small cap investing. Can you walk us through your contrarian thinking?
Sure, I think portfolios need to have small caps. What happens is that small caps have the potential to generate superior return to mid to large caps at the correct point in the cycle. So they are a very valuable addition to a portfolio to generate superior return. There are few reasons why they may help generate superior returns. Small caps tend to trade at a discount to mid to large caps in the same industry. That is because until they become bigger, the market don't necessarily actually understand or don't even recognize the small caps. So if you invest in a small cap at the correct point in the cycle and the small cap grows, that discount might disappear and you might get a superior return than having exposure to a mid to large cap in the same industry. Also, we all have to realize that small caps tend to be smaller players in the same industry. So theoretically, they have a lot more room to grow. So if a small cap based strategy and execution correct, they have the potentially to outgrow mid to large caps in the same industry in terms of percentage. So that means it can generate a superior return. And also other thing is that small caps tend to be have only one business. So that means the profitability tends to be more volatile, tend to be more cyclical. So therefore, once again, if you enter at the correct point in the cycle, you are likely to get higher return. On the first 2 points of the discount to mid to large cap disappearing and the small caps outgrowing the larger players, just reflect back on how Sampath Bank was or Sunshine Holdings was, and to that extent, TJ Lanka was 10 years ago. I mean, they were small caps, and especially Sampath Bank and Sunshine in their respective Sampath Bank in their respective industry outgrew their large peers in terms of percentage. Sunshine saw that their discount to the peers in the industry disappearing as it got uncovered. And TJL used to be such a smaller company with such a large potential room to grow.
Asanka, now I have an additional question to that. I know I mean, this might sound like an unfair question to ask even. Now, what do you think would be the optimal allocation for small cap stocks should be? I know there are a lot of factors that you should consider in the equation, investors, risk appetites, etc. But perhaps, if you can just give like a some idea into into small cap investing, what should be the optimal allocation, let's say, for a retail investor and more like a professional fund manager.
Off the top of my head, what I would say for both categories is that you had to look at your portfolio size versus the tradable market cap of the small cap, and understand what kind of liquidity that you will need to enter and exit. Second thing that you will have to consider is what kind of upside that you are looking at. Bigger the upside, you will have more room to exit a position. So broadly speaking, those are the two things that I will consider when it comes to allocation, which is unique to small caps.
Okay, okay. So with that, we are coming to the next set of question in terms of investment advice. Let's move to fundamental analysis. I would like to know how do you conduct fundamental analysis for companies, and what are the non-negotiable factors you would consider when making investment decisions?
Now, that's what I call unfair question because I think fundamental analysis of companies is fundamental analysis of companies. I don't think that in terms of the process or the steps I'm doing anything materially different. I'm sure that all the fundamental analysts will build detailed models, will go through all the data and come up with detailed forecasts and valuations. Uh, I would say three things that I pay specific attention to. First one is the industry. I believe that it's very difficult for a company to escape the industry's outlook. So I pay a lot of attention to industry analysis, and in academic um, jargon, I will look at Porter's five forces, right? But in a very practical sense. Because I do believe a company's returns are by and large dictated by the industry. Second thing is gathering of primary data. When it comes to fundamental analysis, I think that a mistake all of us sometimes tend to do is to give lot of attention to things like building detail models, etc. But far little time for to check the quality of the assumptions. And in a frontier market like Sri Lanka, where there are quality third-party data providers, you yourself might have to go out there and gather primary data to ensure that the quality of the underlying assumptions are accurate. Because fundamental analysis work on the premise garbage in, garbage out. That means if you put bad assumption, you will get a bad analysis at the end. So quality of the assumptions, improving quality of assumptions by looking at primary data is a key thing for me. Thirdly, if you are managing funds for a longer term mandate, you are looking beyond the near term, I will pay specific attention to the quality of decision makers. It's difficult for you to predict what crisis the company will run into 2 years from now. And sometimes it's difficult for you to figure out how the industry might change in 2 years' time. But if the particular investing company have had a track record of making reasonably accurate decisions in the past, that can be taken as a sign that they will be able to make reasonably accurate decisions even in the future when the environment changes. So quality of the decision makers is a key aspect for me when you are investing for a longer term mandate.
Okay. And when you say quality, the management quality, um, how they treat minority investors, is it also a bigger factor that you'd consider in your equation?
I think, given that as a professional fund manager, I will always be a minority investor, means that I have to look at it. And I encourage all investors to look at minority shareholder protection. But in this specific question, if you are looking at companies' performance, I'm referring to the quality of the management decision or quality of the decision making by the shareholder who's running the business, primarily in relation to running the business.
So Asanka, I have an additional question to that. Now I know that you deal with almost all the sell side equity analysts in Sri Lanka. So now you said you looked at a few criteria when you're looking when you're doing fundamental analysis, including you do a top-down approach when surgically picking stocks, and you gather primary data, and you do like a quality check there, and also you look at the management quality. So I'm trying to understand, how do you rate sell side analyst here? um, are you happy with the output you get, or what should the sell side analyst do differently to help portfolio managers make
Are you
poor.
asking this question in relation to data gathering or in terms of sales side research per se?
Sell side research per se, and what should they do differently? I mean, in your opinion, uh, is there room to improve?
I would say, I think, I would say, off the top of my head, think about stock picking as opposed to producing earning previews, earnings reviews, and maintaining regular coverage. Because in my view, it's the ability to pick a stock which translates into generating superior return. Though I understand once you have initiated coverage, you have an obligation to maintain the coverage at a reasonable level. So, picking stocks is one thing that I think our sell side industry can do a lot more of. Secondly, paying a lot more attention to the accuracy of the forecast and understand the business and the economic cycles. Because after having read quite a lot of research reports over the last, I would say, 9 to 8 years, what I realize is that we do need to learn um, how the sales side reports need to understand that corporate earnings can be cyclical or the economic cycles can be cyclical, so that you don't actually extrapolate near-term earnings to continue into the mid to long term unless there are some valid reasons.
Okay. And how important do you think to build a network of informants rather than just relying on management information when forming your investment decisions, or even doing your assumptions?
So actually, that's a very interesting question brought up. So we hire fresh analysts, and we like to train them. And each one of the analysts is given a technical skills framework, and their designations gets mapped where they are in that technical skills framework. To get the highest level of designation, the key thing which has to be there, or to put in other, to put in other words, the difference between the highest designation in our research team and the second highest designation in our research team is the quality of the network. So I fully agree with you. If you are covering a particular sector, you need to have people to talk to in the industry. So it can be suppliers to the companies that you cover, it can be the customers, it can be the regulators, because you need to be able to assess the outlook of the company independent of what the management is indicating. Because we have realized there's cognitive bias from the management as well. However, they would want to be frank with you. When you're too close to a business, they may not actually see the larger picture. So they said, for leave aside all other reasons, simply for that reason alone, I think it's very important to have a wider network which can independently assess the company's perspective on the outlook.
Okay. Okay. So we discussed fundamental analysis. Now let's come to technical analysis. I'm going to pick your brain on technical analysis now. It's often being said that timing the market is a fool's game. I would like to know where you stand there. How do you approach market timing, and if at all, what factors do you consider when making investment decisions?
I think timing the market is very important, but I think it's very difficult. Also, I like to be a contrarian, but being a contrarian is not useful if the market ultimately does not come around to your thinking and value the share the way you want the market to value the share. So, for me, technical analysis is important to understand how the market is, how the when the market might re-rate certain shares. However, I don't consider myself an expert, and I would like to use experts in technical analysis to answer my question, so I can try to get the market timing correct. However, I think one of the key things that investors in Sri Lankan market need to be careful of is that Sri Lankan market is small. So that means an individual or a group of investors working together will be able to influence the share price movements and the liquidity of a particular share intentionally or unintentionally in such a way it can trigger technical indicators. So I think that is one thing that we all have to be careful when using technical analysis in Sri Lankan context.
Sure, fair point. Fair point. So let's now look at managing cognitive biases. Now, patience and discipline; these two are non-negotiable when it comes to investing. So, what advice would you give to an investor to have a long-term perspective and avoid emotional reactions to short-term market fluctuations?
Vajrapani, in my view, I don't think that investors should have a long-term perspective. What an investor should do is to understand what his investment horizon is, or what his perspective is. It can be long-term, it can be short-term. Then understand that when you are comparing returns, with other investors, that the your investment horizon being different can result in the returns being different temporarily. But if you are committed to a long-term investment horizon, be careful in having emotional reaction to short-term market fluctuations. Because let's assume an investor mandate is for 2 years, and there's another investor who wants to trade in and out, and who does not hold a position for more than a month. So according to the investment horizon and the strategy the second investor is adopting, he will respond to monthly market fluctuation. It's possible that 3 months down the line, given the movement direction in which the market has moved, that he may be sitting on superior returns than the long-term investor. However, if you take a 2-year horizon, that long-term investor probably have to only make one investment decision for 24 months, while the short-term investor has to make 24 investment decisions in that same period. So every investment decision, however good the investor is, fraught with risk. So that short-term investor strategy has higher risk. I mean, history suggests unless that in second investor is an exceptionally skilled investor, that returns of of categories will even out during that investment horizon. So that is something an investor who's committed to a long-term investment horizon has to be aware of, so as to avoid having emotional reactions.
So Asanka, I have an additional question to you on cognitive biases. I would like to know, in your team, how do you manage cognitive biases? Because even as analysts, we do have cognitive biases. Could be recency bias, or could be that we've been covering a stock for a really long time, so we know in and out. So we're kind of married to the stock. So what methods, techniques do you have to avoid cognitive biases? Do you have analysts? Do you debate a lot with the analysts? Okay, maybe one person could wear like a different thinking hat, and okay, these are my arguments for and against for your decision. How does it work?
I think as portfolio managers, we should try to keep open mind and open ourselves for debate and questioning from the people around us, in order to ensure that we don't suffer from biases, but that people around us also need to be from diverse backgrounds. If not, what happens is that you will be debating an investment among a group of people who are thinking very similarly. So it will be no different to not having a debate. So I think the solution for cognitive biases is to open yourself up for viewpoint from people with different backgrounds, and internally have debates, and that ensure that team have diversity of opinions.
Okay, okay. So let's come to the final set of questions in the first segment. Going to have a bit of a moment of truth. I'm going to do a bit of introspection. Now, I would like to know, is there any specific investment decision that has taught you a valuable life lesson when it comes to equity investing? And how did that experience shape your future investment strategies?
So I actually started in the equity markets just as I turned 18 in 2001. I started investing, opened my CTS account before I got a driving license. But I actually started to actively invest after I started working. So between 2007 to 2010, with the help of the post-market rally, I was able to increase my tiny small portfolio by 6 times during those 3 to 4 years.
Okay.
However, and by that time, by the time that I'm talking about, it was very apparent the economy is getting overheated. There's like to be a currency devaluation. Interest rates are likely to be high, and the market valuations are at historical highs. It's a time to exit. But though I have made returns amount to 6 times the original investment, and the market conditions are such, I had a particular portfolio value in mind for a specific reason. So I want to achieve that. So without doing much research, simply on very superficial analysis, I went and invested in a particular share. I think within 3 to 4 weeks of the investment, the market completely turned, and the share in which I invested came down very dramatically. So my portfolio, which was 6 times the original investment, came down to 3 times. So
Okay.
I ended up being so far away from my target value. And
Are you
I mean,
okay?
to me, the key,
Sorry.
Vajrapani.
Yes, Asanka. Sorry, I was going to ask. Are you okay to share what that stock was?
It was Colonial Motors, if I remember right.
Right. Right.
If I remember right, I think that was Colonial Motors, and
So why Colonial Motors?
highly
What was the story?
sorry.
Why Colonial Motors? What was the story back then?
I think just like now, there were a lot of speculation, and I think there was an argument that particular share can be valued given its land value. And I was managing my small investment. I didn't have much experience, and I made that mistake. The key learning point from there is not to chase return. You should always focus on the reasoning and the process in making the investment decision. It's something that I abide by since that particular day.
Okay. Okay. So let me ask another question, almost similar. But what is the biggest mistake you have made in your career as a portfolio manager? Again, what lesson did you learn from that experience?
I think one, I would say, one thought process that I have to get into my head, or one thought that I had to get into my head, is that while you may be correct as the intrinsic value of a particular share, it will be the market that determines that when the market price will reach that intrinsic value, and the market will do it at its own pace. I think that's one of the key learnings that I had to accept as a portfolio manager earlier, very early in the career, and that's something I truly believe in now.
So what happens? Say that you have this perfect conviction, but the market is not believing, and the price is not converging with the intrinsic value. What do you do then? Do you like ruthlessly execute your
It's,
stop loss and exit?
so it depends on the so simple question is, do you believe there's a catalytic event during the investment horizon so that market will realize this is the fair value and re-rate the share, or you believe there will not be such a catalytic value? So if you really think logically, if you think the market will not re-rate the share and market will not experience a catalyst which will force the market to re-rate the share, is there a reason to hold the share? That's a logical question that one should ask oneself.
So, Asanka, my final question in this segment is it about ESG investing? Trying to understand, are you looking at ESG indicators also, particularly when you're making investment decision? Have you seen that increasingly your investors, they also request you to look at ESG indicators more closely, ever so before, because I don't know. To me, I mean, one could argue that there's a lot of marketing here. Case in point, look at the Silicon Bank Valley saga, and even locally also, we've seen some of the PE companies. They are looking at the exit route, masquerading some of the investment as the ESG champions. We've seen some renewable energy companies. They're taking the listing path when their wind power PPPs they're about to expire, and they're about to shift to the lower tier of the tariff structure. So just trying to understand your take on ESG investing.
Interesting question, Vajrapani. I don't think that the fact that some of the ESG discussions globally can be superficial should distract us from the point that ESG factors are very critical for determining the long-term returns of investments. Traditional equity research will look at forecasts for about 3 years at best, right? And also they do tend to ignore, or they will struggle to quantify the impact of ESG risks even in those 3 years. And beyond the detailed forecast, if we are to form a view of the outlook for the business, you need to take into account whether the company's practices relating to environment, social, and governance can undermine your returns. Because in the short term, it may be possible for companies or investors to ignore such factors, but in the longer term, they tend to catch up. As an example, let's make an assumption that a certain company is engaged in unethical business practices. And those unethical business practices will help that business to substantially grow for a certain period of time. But ultimately, the regulator may catch up with that business. Ultimately, there can be backlash in the society against that business. And at that point in time, the investor in that business run the risk of making substantial losses. Also, when it comes to governance, as I mentioned, the quality of management is very critical to navigate a business through various challenges they'll face in the future. You can't actually predict the what are the challenges that will come up, especially in a longer term investment horizon. However, you can assess the quality of governance. So I would say, in short, that ESG is very critical when you are looking to understand long-term returns.
Right. So with that, Asanka, we've come to the end of segment one, topic discussion, and now we are going to the light-hearted question segment. My first question to you in this segment is, what's your favorite book recommendation? And how has it helped you to become a better analyst, better investor?
So there's quite a few interesting books I have come across, but one particular book um, which I want to recall is Thinking in Bits, Making Smarter Decisions when you don't have all the facts. I think that is the title of the book, full title of the book, but Thinking in Bits is the popular name. This book has been written by Annie Duke. Annie Duke is a professional poker player and also a decision strategist. She, I think, almost got a PhD in psychology from University of Columbia. I think after submitting her thesis, due to personal preference, she gave up defending it in a viva and walked away. She has become a very successful poker player, and she has brought this thinking about how to make good decisions. To me, the key takeaway from that particular book is don't do resulting. Resulting means judging the
Don't do?
quality of a decision based on its outcome. It is based on the premise that outcome of a decision is the result of both the decision and an element of randomness, or what you would commonly call luck. So, as an example, in a poker game, you can be dealt a hand with aces and play well but still lose. In the same way, you can be dealt a hand with sevens and twos, play badly, and still win. And that's the same when it comes to investment. So, for me, the key thing is if a particular investment decision has led to the right outcome, please reflect back to see how much the decision and the rationalization behind the decision contributed to that outcome and how much of it was due to luck. If a particular investment decision has led to a bad outcome, to see how much that the weaknesses in rationalization and the decision making process led to that outcome, how much of it is due to misfortune. Because it's very important that we don't judge the quality of the decision making based on returns, because when it comes to investment management, very similar to many other industries where you deal with uncertainty, you are only going to be correct 60 to 70% of the time, even if you are the best fund manager. So for me, that the the way to the approach to analyze decision making articulated in thinking in bets is quite useful.
Okay, so that reminds me the metaphor life is a big poker game. Uh, I guess day-to-day life we are dealing with incomplete information. The outcomes are uncertain, so it's all about
Yeah,
making.
it actually goes back to something I would say even Steve Jobs said. Steve Jobs, I think it's Steve Jobs who said that you can only connect the dots looking back. What it tells you is that you certain things only make sense at the very end. But what it tells you is that when you decide to take a certain path which may have led to the outcome, you might actually be taking this path for reasons very different. So if you when you connect the dot, you actually go and say, look, I arrived at this particular destination because of decision, solely because of the decision made in the past. You might be coming to the wrong conclusion. There would have been an element of randomness which led to that outcome.
So when you look back and when you try to connect the dots, do you write down your investment thesis? I mean, what did go right, what did go wrong? Do you do that kind of thing?
Obviously, as an institution, that we document the investment thesis, but I think ideally every fund manager should probably keep a journal where they can quietly reflect on their decisions, both at the point of making the decision and when the outcome materializes. But I'm not going to say I'm disciplined enough to do it every time. I wish I was that disciplined.
Okay. So I'm definitely going to read up on your book. And when we had the pre-discussion, you said me, this is your favorite book, and it gives thinking in bed. So and then I remember then there was this podcast, Lex Friedman podcast I watched a few months ago. He did a podcast with a poker champion again, just like Annie. And I was listening to it and thinking, perhaps poker players, they make good investors because if you look at the skill set, it's almost identical. Let it, I mean, be risk management, be discipline, and even analytical skills. This poker champion Daniel, I think Necker, who I can remember, he said that. So there are two strategies. One is the game theory optimal strategies. One is the exploitative strategies. Where in the game theory optimal strategies, regardless of what the opponent is doing, you do what is mathematically optimal. Whereas in the exploitative strategies, you do, you will try to identify the weakness of the opponent and then try to attack it. So I was thinking, perhaps poker players, they make really good investors. Do you play a lot of
Yes,
poker?
I mean they are also when going back to what thinking in bed say, it's very important that we don't go and say just because a certain poker player is successful, he's actually a good decision maker, right? Because if you have only watched him for a certain period of time, it could be that in terms of randomness,
Mm,
he's being lucky for that period of time, and over a period of time it can reverse. So ultimately the key thing is that you have to go back and analyze the rationalization and the quality of the decision making independent of whether the person has been successful or not.
correct, correct, understood. So in this thread, I mean, it's a given that you have to do a lot of reading. So I'd like to know, how do you stay up to date with the latest trends and the insights happening in the investment world?
So I think there's a lot of information which goes around, a lot more in these days compared with 5 to 10 years ago. And also everybody's lifestyle is so hectic. I tend to read by using Audible, because that helps me save time while at the same time keep in touch with what is happening around the world. Um, Also, I have a few podcasts I like, especially the Masters in Business podcast done by Barry Ritholtz at Bloomberg. I find that quite useful as well.
Listen here, I'm going to write it down. What did you say the name was, Asanka?
Masters in Business by Barry Ritholtz.
Right. Uh, so, okay, you said you listen to a lot of Audible, but how do you, I mean, could be audiobooks or hardcover books. How do you retain the knowledge you acquire? Do you have very good note-taking habits?
Well, you presume that I'm retaining any knowledge. The point is, I don't have a strategy as such. If I feel like I need to listen to a book again, I will listen to a book again. If I feel like I need to read it again, I need to read it. I know some people have fairly sophisticated and probably ideal ways of retaining, like taking down notes, etc. But sadly, I'm not as disciplined.
Okay. So, are there like any annual mandatory customary rereads that you do? You go back every year to read that book and then you see a new layer.
I think there are two books that I tend to reread from time to time. One is a book called Flying Without a Net. It's a book written by former, I believe, director or a managing director at Morgan Stanley, who went on to become a professor at Harvard Business School. It's about taking risk in lives, right? As implied by the title Flying Without a Net. There's another book called Grit. I can't recall the name of the author. I feel those two books have inculcated certain values in me. So from time to time, just to refresh my minds, I go back and reread all those books, two books.
Okay. Okay. So with that, we are coming to the final question. Who's your favorite person to invite for a dinner party, or in other words, whom do you admire the most in the industry?
I think it's a tough question to ask, because I try to tell myself that I need to remain objective and not be a fanboy for a particular person. But one person I would probably like to meet is Ray Dalio. Ray Dalio is the co-founder of world's largest hedge fund, Bridgewater Associates. He has been credited with many of the innovations in the hedge fund industry since 1970s, like inflation index, bond management, etc. What interests me about Ray Dalio um, is his thoughts on the outlook for the world. I personally believe that history doesn't repeat; it rhymes. I believe that when people say that we have never seen this ever before, that people are suffering from mistaken belief just because it hasn't happened in their lifetime, it hasn't happened before. So Ray Dalio has this interesting perspective that that the world from time to time goes through these long-term cycles, and a country's success or failure can depend on where they are in that cycle, right? And these long cycles are characterized by emergence of a superpower and the collapse of the superpower. He talks about three things. One is that long long cycle in debt, money, and economic management, internal stability and chaos cycle, external stability and chaos cycle. He feels when all of those three things fail at the same time, it's a sign of breakdown of the existing global cycle, leading to a potentially a new cycle. So if you look at it, I think since mid 1980s, we are increasingly having economic crisis. Our economic cycles have become shorter, and the number of sovereign debt crisis we have been having has increased. Now, if you today look at US is struggling with controlling inflation on one side, and at the same time ensuring that economic growth is maintained at a certain level. There's so much because of because of very material increase in debt stock, and due to keeping interest rates low for a prolonged period of time, we are almost in a crisis over there in US. And also if you look at many of the Western countries and US, the internal chaos is increasing because of globalization over the last 30 to 40 years. The middle to lower income classes in the developed countries have seen the real income come down, so the income disparity has increased. That has led to populist politicians getting appointed, right? So there's a lot more internal chaos today compared with a while ago. And if you look at the external side, you can see emerging superpowers like China, India, as well as old powers like Russia trying to exert their power at the global stage and trying to challenge US in comparison to a lot more than in comparison to any other point in the last 30, 40 years. There's an article. So there's an article by there's a outlook piece by Jim Reed, Deutsche Bank credit strategist, saying that European sovereign borders have not been as stable as this since as stable as this for this length of time at any point in human civilization. He published that report about I think 3 years ago, and for the first time since the end of the Second World War, the European sovereign borders are under threat from Russia. So all of these three things put together, it looks as if we are coming to the end of another global cycle. So I mean, I would like to meet Ray Dalio simply to pick his thoughts on this particular topic.
So Asanka, I can't help but ask, let's say, assume hypothetically, you get to meet Ray Dalio and you get to have dinner with him. What would be the type of question you'd ask from him? Now given now you said how important it is to look at history, and I believe from the little you said you are a big history buff. So perhaps I would like to know, what kind of questions you'd ask from him.
I think as an investor, there's a very interesting question to ask from him. That in the event of a chaotic transition of power, when one global order ends and another one begins, how do you preserve your wealth? How do you position your global portfolio? Here we are not speaking about whether to invest in Sri Lankan equity or fixed income, etc. There could be certain countries who might actually come through as winners, and having exposure to that country, having exposure to the commodities produced by that country, having exposure to the currency of that country can create generational wealth. Very similar to how certain individuals and companies would have made generational wealth when the colonial power shifted from to Britain from the Dutch.
Sure. So let me ask, if you were Ray Dalio, uh, where are you going to invest right now?
Interesting question. I think I will look at making investments in Africa, because Africa probably have the world's fastest growing and the youngest population. They have a lot of commodities. Historically, Africa has been unstable, but I think most of the other regions are going to experience slowdown in population growth, population aging, the overheating of their respective currencies, etc. So my outside bet would be to have exposure to Africa.
Okay. Uh, why wouldn't you look at India or China for that matter?
That's a tough question, but if you want an completely, probably an uncorrelated exposure, which at very cheap prices, I would still say you may have to look at Africa. It could be that India and China is also attractive, but India and China has already attracted quite a lot of investors. So in that sense, Africa could be attractive, what I feel.
Right. So with that, we are coming to the final question in this podcast. Asanka, my question is, now this is a question that I ask from all my guests. Are you a good cook? And if you were to host Ray Dalio over dinner, what will you be cooking for him?
I'm not a good cook. I'll probably have to get somebody to cook or take him out for dinner somewhere. I think if I cook, that'll probably the last dinner or the last time he will speak to me.
Okay. Okay, so with that, we have come to the end of today's podcast. So, Asanka, any final remarks for our listeners? I mean, if you could give one piece of advice for our listeners, what would that be?
This is advice which is true to myself as well, right? That strike the right balance between being open for feedback, being open for ideas from others, because you have to be careful to ensure that your cognitive biases are addressed. But at the same time, you need to have the conviction in your investment case so that you don't unnecessarily change your decision based on the feedback and ideas from others. I think striking that right balance is key in investment management, and it's tough.
It sure is tough. So, dear listeners, with that, we have come to the end of today's discussion. Thank you so much, Asanka, for sharing your knowledge with us. We took a long time, and very grateful we are, and we definitely look forward to talking to you again in another episode. So, dear listeners, thank you for joining. We will see you again soon.
Thanks, Vajrapani. It was a pleasure.